Welcome to Financial Accounting with Anne Marie Anderson. Let's explore short-term liabilities and provide some common examples. First, let's start with the definition. Short-term liabilities, also known as current liabilities, are financial obligations a company or individual must settle within 1 year or the operating cycle, whichever is longer. Put simply, you owe someone something, whether it's money or you owe a service, and it must be paid in less than a year or operating cycle. Let's start with some of the most common short-term liabilities. Accounts payable. Let's visit Bobby's lemonade stand at the local market. Bobby's lemonade sells faster than he can make it. Since it's gotten so popular, Bobby has decided to scale up and increase his profits. Unfortunately, that upscale means that Bobby just can't take the lemons from his mom's kitchen. Now he has to pay a lemon supplier, a sugar farmer, a cup producer, rent on his new factory, salaries of employees, not to mention utilities. These are all expenses of running the business, and as the obligations arise, it creates an account payable until that bill is paid. Example, the journal entry to buy supplies on account is a debit to supplies, which is an asset account, and a credit to accounts payable, a liability account. Let's talk about sales taxes payable. Have you ever been to the store and bought something that cost $100, but then after tax it's $107? What's with that extra $7? Well, that $7 is collected by the store and has to be paid to the government. So while they hold on to it until they make that payment, it is a current liability. The journal entry for the collection of those taxes is a debit to cash, an asset account, for $107, and a credit to sales taxes payable for $7, a liability account, and a credit to sales revenue for the $100 actual sale. Moving on to unearned revenue, which is a different type of liability altogether, because rather than owing money, you owe a service. Let me explain. A new customer of Bobby's wants to pay for a year of lemonade in advance. Great news for Bobby to get all that cash, but he still owes his customer a year's worth of lemonade. That's a liability. So while the journal entry records cash, the credit is to the liability of unearned revenue. Notes payable. Bobby wants to borrow some money from the bank to expand operations a bit, but he's confident that he will be able to pay back the loan in less than a year. That's classified as a short-term liability. The journal entry is a debit to cash for Bobby and a note payable that must be paid in less than 1 year. Lastly, a vacation pay payable. As an employee that gets paid for days off, the company must accrue the vacation pay as it's earned. What does that mean? Well, if an employee gets 12 vacation days a year, the company must accrue 1 day of wages per month, so when the employee takes their vacation time, the money has been set aside to make that payment. The journal entry is a debit to vacation benefits expense and a credit to vacation benefits payable. Why does a company care if a liability is short-term? Understanding all the obligations that will come due within the next year is vital to analyzing the liquidity of your business. Thank you for watching. If you want to learn more about liabilities, please see additional videos on my channel.